Uh, Hi, friends. Today we have a super interesting guest with us, Mr. Kalpen Parekh, the CEO of DSP Mutual Fund. Hi, Kalpen. We are
Hi,
glad
Arun.
to have you and look forward to a super interesting conversation.
Looking forward, same here. Always nice to connect with you. And I hope you don't ask too many difficult questions.
It should be simple for you, hopefully.
Yeah.
So yeah, Kalvin. So just to start off with, one of the things that we noticed about DSP Mutual Fund is that for a long time you've been talking and you've been like relentlessly talking about investment framework. Right now, before we delve into it, a lot of us might switch off on hearing a technical
The
term
term.
called investment framework. So just can you break it down for our viewers on what is an investment framework? Probably how should somebody understand it? What's it actually?
So, I would love to get a simpler word for this, if possible. Uh, and in absence of that, we thought we start with the word investment framework. But actually, if you look at it, it's nothing but rules of investing. And every individual has a certain personality and certain belief systems in money management, and especially in a large fund house like DSP. We have a diverse set of investment professionals, diverse set of schemes as well, and diverse set of investors with different time horizons. uh, Ideally, one can say that just have one scheme and let everyone come into that scheme, but we cater to 25 lakh investors and different time horizons and different customer segments. On the other hand, the investment markets where we actually allocate money either in debt or in equity are laced with lots of fluctuations in the short term as well as in the long term. So, how do you make sense of changing data points, changing trends in terms of opportunities to invest, as well as changing risk perception? Um, in a way, the whole concept or the idea of investment framework is nothing but having certain technique, formula, or method of investing. So what we say is that what is going to be our method of investing, and as investors and advisors, we would love you to know what is our method of investing. And if you, along with us, understand the method right, it will help you in choosing the right fund, number one. It will help you in understanding why we do what we do. And in good times and bad times, it will give you a reference point to measure us uh, versus measuring only on the outcome. So it is very fashionable to say that investment firms are process driven, right? No one will say we are not process driven. We all will say we are process driven. Uh, but then if you were to ask me a more difficult question, okay, show me the process. Um, I'm sure that's where a big opportunity as an investment industry lies in terms of putting out the thoughts which are there in our mind in a very clearly articulated way, and ideally as simply put as possible, which is a work in progress for us, so that investors can understand why we do what we do. So that's the first starting point of having frameworks laid out. So my view is that every fund manager, every fund house will have their own frameworks. Some of them are well defined and well articulated. Some of them are not articulated. We are just making an attempt to come closer to our investors and to our advisors to help them understand us beyond just understanding the short-term views of the market and prices and near-term policy actions, which are anyways outside our control. What is in our control is how we behave at different points in time, and that is the reason why we felt that as a team across all assets that we manage domestic equity, we manage fixed income, and we manage long short absolute return funds. You should have a document in front of you which will tell you how will we act at different points in time, and that is how the whole journey of uh, putting out our investment frameworks started. So that was our first objective. Having said that, while we started this journey, what we realized is that it started adding lot of value to ourselves. It started telling us that, okay, if this is what our technique should be, but maybe here is our opportunity to make it better, to make it sharper, to make improvisations. While we were putting out our framework, we realized, but okay, these are the mistakes we have made. These are the mistakes we are currently making. These are the moments where we are actually deviating from the framework. Now, do we have a strong reason to deviate? Then okay, fine. There is, because you can't operate in a binary world where things are moving very fast. So you have to be reasonably adaptive to the market. but not at the cost of diluting alignment to the framework. So frameworks and rules give you discipline, they give you clarity, they make the investor better aware of what we stand for, and which is why we are very excited to always start conversations with what our investment beliefs are. So framework is nothing but articulation of our beliefs to the outside world.
Okay, okay. So just a step adding to that same question. So let's assume if I am a normal, simple investor, for most of the other facets in life, it's a very simple thing that if the process is good, eventually the outcome is also good. At least for most of the other
Absolutely.
activities in life. So let's assume I go to a restaurant, the dosa is great. And every time I go, the dosa is great. So for me, the simple framework is that the outcome is anyway great. So I don't need to worry about what methods or what rules they follow to make the dosa great, because that's more to do with that particular hotel. So if so logically there is a possibility that we naturally tend to think about investments also in a very similar manner, that hey, investment frameworks are great. It is of course a compulsion, but the point is it isn't that something that only the fund manager should worry about? As an investor,
Absolutely.
a good process should lead to a good outcome. So why shouldn't I only go with a good outcome rather than why should I go the next step? Where does the disconnect between a good process and a good outcome happen when it comes to investing, unlike the other aspects of our life?
Absolutely. So, see, definitely at one hand, as an investor, I should be worried about the simplicity of knowing what this product is and what will it achieve for me and how has it behaved over the last 10, 15, or 20 years. And the proof of the pudding is in the returns, end of the day. None of this matters if your final returns are not in line with the expectation of the fund.
Right.
So I think I completely agree that the investor should largely be worried about the outcome, because even when he buys a car, he doesn't know what goes inside the design of the machine, what is the torque of the car, what is the RPM, and things like that. Or he buys a medicine, he doesn't know what is the composition of the medicine. All he knows that if I have cold, then this is the pill I should take, and likewise. So this is more valuable to us as money managers to start with. Like I said, our initial starting thought was that let us lay it out to the investors, but the journey turned out to be more valuable to us as well, which helps us stick to those frameworks and achieve our performance goals. And it helps us in measuring our own efforts, our own teams, and their performance every year in line with what we have stated. Having said that, where does it also help is, see, in investing, there are different routes that take you to your heaven. Or like if you go to a multi-cuisine restaurant, you get different styles of food. You get Indian, South Indian, continental, Chinese, Mexican, and so on and so forth. Um, so here, our second step attempt, apart from the frameworks being useful to us, is to help investors identify what each of these styles are. And a lot of retail investors who have less money to invest may not really diversify their money across multiple styles. But like I said, we also cater to large, high net worth individuals, as well as institutional investors, as well as global investors who come from outside and invest billions of dollars for 10, 15, and 20 years. So they need to know that the food that you're serving me, which slice is it, and am I aligned to that slice? So if I want Chinese food, are you giving me Chinese food, or are you giving me? How do I choose amongst your funds? So one way of choosing funds is equity fund, multi-cap fund, large cap fund, mid cap fund, and so on and so forth. These are level 3, level 4 labels. What is important is what are the principles that go into building these funds, and what are the styles they are. So we have funds which are more anchored around quality and growth as one bucket, then anchored around quality and value as another bucket, then anchored around freestyle, which will move between anything which the fund manager thinks is likely to do well in the near to medium term as the third style, and the fourth style is attempt towards absolute returns. So these are more relevant to advisors in terms of knowing where to fit these funds and then accordingly recommend to their end clients. But the biggest beneficiary of articulation of this investment framework to start with is DSP itself.
Okay. So just coming on to the execution of these
Yeah.
investment frameworks, obviously there are two parts to it. One is probably very objective, the rules or the methods which go into it. And there's also the second subjective part of it where the fund manager brings his experience, his nuances into it. So there's also a discretion involved.
Sure.
So how do you balance both of these, and where do you draw the line?
So actually, the first part is subjective because the design of the framework starts from the human being. The framework is the manager's framework, right? Because he is the one who says. So what are we trying to solve for here, Arun? What we are saying is that the reason for active funds to exist is that they should do better than the simpler alternative that the investor has. Today in equity, the investor has a very simple alternative of putting his money in Nifty and Nifty Next. And these two indices have done reasonably well over the last 5 to 10 years. Maybe over 20 years, active funds have generated significantly higher returns. But over the last 5 and 10 years, the Nifty Next itself has been a very formidable index to outperform. What is our promise to the investor, or what is our objective? That you know, our attempt will be to identify the best companies from the underlying playground that is given to us, and over a cycle of 3 to 5 years, generate better returns than what the benchmarks generate. So we start by asking that what are the sources of return for any asset class, whether it's equity or whether it's fixed income. So that's what we articulate first. Then the second question is that to achieve this source of return, what is the risk that we are taking? And how do we really manage that risk? Because no return is coming free of cost. It's coming with some amount of risk. Is that risk something that we understand well and can manage well? Then we say that, okay, what are our beliefs about generating excess returns over the benchmark? So if over time benchmark is going to give X and we aspire to do X plus 3 or 4 or 5, what type of businesses will do better than the average of all businesses? So if I say that our beliefs are A, B, C, we need to test it over history, that over long periods of time and more often do A, B, and C deliver more value than the benchmark itself. So that becomes evidencing. So you start by first laying out your beliefs of alpha generation, what will generate excess returns over benchmark. Second, what is the evidence of those beliefs? Are these just beliefs? Like we say that, if you are a good human being, you'll go to heaven. It's a belief. But there's no evidence of that yet, right? We'll get to know only when we cross the line. But at least in investing, with whatever 20-year history India has and 50-year history the rest of the world has in capital markets, there are some beliefs, and that they can be easily evidenced. That companies which survive will do well, companies with good managements will do well, companies with low leverage will do well, and all of these can be converted into numbers. So the fund manager himself, with his decades of experience, has evolved these beliefs over time, has over time learned these beliefs. Then we evidence them, and then we put it together in a written document, and then we measure the portfolio against these beliefs, and then quarter on quarter we just keep reflecting back that, okay, this is the belief document and this is the portfolio. How much is the alignment? Because what can happen is, while these beliefs are hard coded in the document, but businesses don't operate as per our beliefs. Business will keep changing. Managements also may keep changing their execution strategy. Sometimes they'll go right, sometimes they'll go wrong. Return ratios will change, prices will change, valuations will change. So we keep an eye on both these things, and then use this as an anchor point to say that, okay, this is the way we will pick companies. So if the portfolio, which is highly quality conscious, will focus a lot more on stability of earnings and reasonably high return ratios. We'll have less emphasis on valuation alone, and say that, okay, I will continue to own these companies which are able to keep reinvesting the cash flows they generate at higher rates of return, at higher return on capital ratios, and stay for long. So our whole approach here is that so far it is the portfolio manager and the human subjectivity which is giving the belief system, and that's from there on the system takes over to say, okay, now let's look back with data that whether this belief system has alpha, and then are we following these belief systems every month, every quarter. Having said that, we do have, see, this is not about purely running a quant fund. For that, we have a separate fund, which is called the DSP quant fund. Uh, we also recognize that trends change, and your framework has to be adaptive. So we say that roughly between 70 to 100% of the portfolio should reflect whatever we have hard coded in terms of our belief system, and we leave room for 0 to 30% to the portfolio manager to say that, okay, I think that these few companies are likely to do very well in the near term because of some triggers or some changes likely to happen in the macro environment or the frame policy environment. Or today these companies don't have high ROEs, but 2 years later they are in the journey of moving from a low ROE business to a high ROE business. Today these companies don't fulfill our debt to equity ratio, but in the next 3 years, because of the cash flow generation and no new capex, the debt will come down and they will become a part of my framework. So hence, we don't mind having up to one third of the portfolio into companies which are potential migration candidates into the framework. And here, if you get these right, you also make relatively higher returns because they are typically the undervalued or contrarian stocks which the market is having a different view on. And sometimes you go wrong as well. There are times when you think that, okay, these companies will transition into our belief system, but bad luck. They were not able to get there. So there are hits and misses. Our attempt is to constantly learn from the misses and fine tune and strengthen our approach and get better at what we do. So that's exactly how we blend the combination of human judgment, the wisdom of experience of portfolio managers over cycles, as well as give themselves a framework within which they can operate and take decisions. And then end of the year when we measure our teams, this acts as a very important anchor to measure our efforts. So how do you really measure efforts? So typically efforts are measured through outcomes alone, but we've made some changes in that, which I'll talk about later on.
So, so once you put the belief system into these different funds, what we've
Yeah,
also noticed is that across both globally and domestically, all funds go through. I mean, even the best of the best funds go through temporary periods of underperformance, and eventually it might be because of that particular style being out of favor, or one of the other investment factors being out of favor, whatever be the reason.
true.
So then it has to underperform. So net DSP funds also at different points in time, different funds might underperform.
Absolutely.
Now as an investor, it gives me two problems. One, it's an underperformance that is still fine. So how do I differentiate between a genuinely bad fund going through underperformance vis-a-vis a good fund going through underperform, because it's a phase underperformance looks underperformance. So
Yeah.
how does somebody draw the line saying this underperformance is okay?
Okay. Yeah, so this is again hard work because my view in this is that while we want to make investing very simple, but oversimplification may not help you become a better investor and create long-term wealth. Otherwise, typically what happens, we as investors and human beings, we are wired to like recent performance and recent outperformance. We always like to buy what is doing very well. Like, Ben Graham has said very beautifully that you should invest in stocks the way you would buy groceries, not the way you would buy perfumes. But our mindset is designed to invest the perfumes of today, which effectively then become the vegetables of tomorrow because there are cycles of performance of the asset class as well as of the portfolio manager and the style. And here is where that awareness of why is this fund doing what it is doing, and if I believe in what it is doing, then whether it outperforms or underperforms temporarily becomes secondary. Then it allows me to take a view. So what are we doing? We are just, by putting out these frameworks, we are enabling a customer to actually evaluate our performance more objectively and even evaluate our poor performance more objectively. So even if we are, like there could be phases when genuinely for, we are actually not doing well. We are doing a bad job. But the framework will help you evaluate that is that temporary or is that structural. And that effort to know that, okay, what is the reason behind portfolio action? Why is the portfolio buying these companies and not buying these companies? And I'll give you a real example. One of the funds within our bouquet, which is my second largest holding personally as well, which is the DSP Equity Fund. And within Indian equity portfolio, it is my largest holding. When I joined the company around 3 years back, it was the boom of the small caps. And we have a very credible small cap fund, which has been around for 12, 13 years. And when I joined the company, the small cap fund was sitting at 40% CAGR for the last 5 years. Because, okay, so when you just look at returns, and against that, the multi-cap fund, the DSP equity fund, for example, was at maybe half the returns in the same period. So left to my native human brain and my bias, I would have preferred to invest in the small cap fund. Uh, uh, but when you have a framework and a framework which says that valuations matter, valuations mean revert, and what has run up or deviated significantly from its core long-term averages could consolidate in the next few years. But what has not run up yet could actually deliver more value in the next round. And having that detailed conversation with both the portfolio managers, with Vineet for the small cap strategy and with Atul Bole for the equity strategy, gave us a sense that uh, it is more prudent right now to be in a fund which is between the two categories giving lower returns. But the risk of overvaluation resided aggressively in the small cap at that point in time. So one, it helped me take the decision that I should incrementally invest initially more with the equity fund. But two, it helped the whole equity team and the organization to take another decision that if we believe that the small cap space has become very frothy, then let's guide our investors by saying no to taking money there. So again, presence of these frameworks at a asset class level enable you to say that okay, particularly in small caps where free float is less, liquidity is generally less, impact costs are very high in times of extreme pessimism or optimism. So it allowed us to take that decision that let's stop the fund for a long period of time, and only after almost 2.5 years. In fact, just around a month back in April, we felt that now the turning point of the other cycle has come, where valuations are now, average or lower than long-term averages, and companies are pricing in a lot of pessimism, and there's a lot of bad news, and the category is seeing outflow. So these are all classical tick marks to say that okay, large part of the risk is in the price now. So this is how, as an investor, it helps me to say that okay, having read the framework. Now let me give you another example. We have, let's say, another fund which is more value conscious, and the value conscious fund at that point in time or even today will have exposure to companies which have relatively lower ROEs or ROCEs at this point in time, will have slightly high leverage than the quality bucket of portfolios, and will need some triggers for a turning point into the next 3 to 5 years. Now, as an investor, my preference is I don't mind living through 3 4 years of underperformance. In fact, I seek underperformance. If I know that the investment manager's principles are sound, his fundamental execution is sound, and if the investment team is truly authentic to its belief system and will follow it at all points in time, I will choose a fund which is underperforming rather than a fund which is outperforming. That has been my big learning in portfolio construction as an individual investor. So now today, for example, in the DSP restaurant, when I walk in and I have these two plates, value as a style and quality as a style. Quality is expensive, value is cheap, but value needs triggers. Value has a lot of other regulatory challenges. It may have challenges of the owner, of the management, whereas quality may not have those type of challenges. Now, my personality, for example, may say I want to play safe, so I will stick to the quality bucket, and the quality bucket has higher valuation risk. So I will under allocate. So instead of 100 rupees, I will invest 50 rupees today versus allocating 75 rupees to value just because valuations are cheap. Now, knowing that what is each fund all about through the framework is where the real value add to the investor happens, and he is then able to choose the fund depending on what his preference is. Now, there are many successful investors who prefer that okay, I will not buy quality at any price. I think that giving any price to businesses can give you near to medium term underperform. In the long term, you'll win, but in the near to short term, you can underperform. So I would want to add a little bit of value to my portfolio, and or rather more of value to my portfolio right now, and have that. So that's the whole design, that give diversity of styles and then give clarity of each style so that you can pick and choose, and then you can analyze whether the performance is because of the style underperformance or because of the deviation in execution or because of fundamentally both being wrong. Uh, So if we didn't have any of this, then you have to just rely on our word and perception of who we are, um, which also works in some cases. But we are saying that when we want to build a long-term franchise, a long-term institution which has a 25-year history behind it, and maybe another multi-decade history ahead, we want investors who also learn along with us, who are aligned, and who can live through short-term underperformance. And the other important point is we realize that investor portfolios do better when they have current underperformers. If your new money is invested to current underperformers, there is a high chance that when the reversion to mean happens, you are able to do better than the benchmark. So these are some very basic thumb rules which we are trying to put together and ensure that the experience to our investors is sensible. Over a cycle, uh, see, India is a country with more money in fixed income. 100 lakh crores is in fixed deposits. Uh, so if we don't exist in the lives of our customers, they will earn that 5 to 7% fixed deposit return without any worry. Now, our presence has to constantly add value to them. Now, when you look at data in any equity category around the world, money comes at peak of cycles and goes out at the bottom of cycles. So the actual return to the investor eventually in his account statement is less than fixed deposits. So in spite of our great intent and good execution, we are not able to help the investor beat his alternative outcomes. And that's where we feel that some of this effort, these are all long-term efforts. They do take their time to become mainstream, but we are committed to give transparency and accountability to ourselves and to our investors.
Got it, Kalpen. I mean, that's a very elaborate and very clear answer. So just dwelling on this point a little further. So one of the things that we've noticed is that the evaluation of returns, as you told, has a lot of these nuances. So underperformance might be good in a lot of cases.
Yeah.
So when an investor is evaluating, it's very subjective, right? Somebody says 3 months is long term, somebody says 5 years, and so how do you do it from your side so that
Okay.
investors can align to the same expectation, so that I know
Sure.
that DSP evaluates their underperformance or their
Okay.
outperformance on these metrics. So as an investor, if I'm okay with that, I can align with
Yes.
those same expectations.
Okay. So at two levels, I'll highlight one, how we internally, how our investment team measures itself, or what is my measurement for the investment function for both equity and fixed income. It's a function of the ideal time horizon for a particular asset class. So we have done two, three things in the last couple of years. We have tweaked, we've gone back to first principles. That what are we here for? We are here for alpha generation on the active range. Now we realize that traditionally most funds are measured by investors and advisors, by managers or fund houses themselves on peer group comparison. We measure ourselves to each other. So is my shirt more wide than your shirt? The classical surf and rin ad. So we said our measurement has to be to the benchmark because benchmark is our alternative. So we've moved our measurement to so we evaluate our fund managers on alpha, not on peer group. Because peer group is very difficult. Every peer could have different styles. There's no point in constantly running around. So our single-minded focus is you should generate alpha over the cycle. So I'm not insisting our team to generate alpha every day because that's not you can't hit a six on every ball. There are some balls you have to defend, some you have to let go. There are some phases where you just have to say that today it's a bad pitch. I don't want to defend my wicket, but the market may be running up that time. So we measure teams on alpha and we measure them on rolling alpha over a 3-year cycle. So we give a reasonable time horizon for the portfolio to play out. And on a rolling 3-year basis, if it is generating alpha consistently, the fund manager gets a better score. But on a rolling 3-year basis, if the numbers are poor, the fund manager gets a poor. 1 year alpha is very good in one fund, and the second fund, the 1 year alpha is very poor. Doesn't mean the second fund manager is not done well. So what we look for is he sticking to framework? Is the framework robust? We constantly keep fine tuning the framework. And if he's sticking to the framework and still underperforming temporarily, we are fine with that. Same example of DSP equity fund. I think the year 2018, the fund was 3. So in traditional, it didn't do well. But in our system, we rate manager very highly because true to legal, sticking to framework. Entire portfolio was matched to what it stated, and in 2019 and 20, it is the top decile fund today. Uh, so what we do is we give confidence to the investment manager that play your style. You are here because we like your judgment, your experience. Don't not express it just because the market is not aligning temporarily. As long as the style is fundamental. So we measure the team on alpha. We measure the team on rolling returns over 3 years. We measure the team on risk. For example, we have a metric that how many stocks or what percent of the portfolio has very high drawdowns, 50% and above, for example. Because if companies fall with such sharp price drawdowns, then we have to really fundamentally question that did we go wrong? Um, and then we measure the fund manager on red flags. So we have created a new role at DSP called the skeptical analyst, and the whole idea is to try and minimize accidents which occur out of accounting, misjudgment or going wrong on understanding the management and the numbers. And that to us is not acceptable. We should not go wrong on that basic premise. We could go wrong on a certain valuation or understanding of a macro trend, that's fine, but not on very granular balance sheet data. So that's again another important measurement. So simply put, the measurement is on 4 pillars: on alignment to framework, on alpha generation on a rolling basis, on portfolios not having any accidents on accounting on account of forensic risk, and the fourth one is on communication. Communicate very transparently and consistently so that investors understand what your style is. So that's how we measure our portfolio managers. When it comes to investing, let's say if I am a common investor, and I am, when I make my investment decision, what do we look for? Or if someone says that I want to put money in equity, what should be the ideal time horizon? And here what I say is that look at the fund or the market. Take equity as a market and see that what has been the minimum time horizon for which the market has given zero returns. Now, if you analyze that for Nifty or Sensex to start with, that number is as high as 6 to 7 years. So for a long period of 6 to 7 years, you could have earned zero returns. If your starting point was bad, if your starting point was euphoria and extreme optimism reflected through crazy valuations, generally in the next 3, 5, 7 years, returns are either zero or less than fixed income. So what we tell investors is that your minimum horizon to achieve more than alternative fixed income return of 6 or 7% in India has to be at least 7 to 8 years. And for sake of simplicity, we say keep tenure as a ideal time horizon because it covers up for a long market cycle. It covers up for a business and economic cycle. It also is when real compounding of wealth happens. So if you earn 20% for 3 years versus 12% for 10 years, 12% has created more absolute wealth than 20%. So which is why for equity as an asset class, tenure is what becomes very, very critical. So even in our public literature, even on our website, we actually highlight minimum rolling returns. We make investors look at what is our minimum rolling return. So and we show that in 1 year, this fund minimum worst case return is minus 55. In 3 years, it is minus 8. In 5 years, it could be minus 1. Which means you should be aware that even if you come with a 5 year view, you could still not make more than fixed income. Now, this is an exercise in wanting to do very transparent communication about what can go wrong. So when we restarted our small cap fund, for example, just recently, 1 month back, our first announcement ad was minus 67%. Uh, and it was not 13% CAGR over 12 years. So we had two options that the fund has given 13% over 12 years, which triggers positive response, minus 67, which triggers a response of fear. But we want investors to be fearful when they are evaluating their investment so that the dimension of risk is well known to them and they understand that, okay, there can be volatility in equity as an asset class. So that's how we put the two together, measurement internally and how do we give matrix to customers and investors outside so that they can measure us objectively.
Right. So, Kalpen, you were mentioning on the first principles that the basic logic of your equity bouquet would be to outperform your benchmark over a 3 year rolling cycle,
Yeah.
over a market cycle. So, if with that as a core first principle, you also have a bouquet of passive benchmark oriented fund. So how does somebody think about the passive basket? Because while you have an active basket whose only mandate is to outperform the passive basket. So what relevance does the passive basket play?
Yeah. So the relevance of the passive basket is, if our active basket loses its relevance, we don't want you as an investor to lose out because of that. And in a way, it is your own risk planning that
Right.
if for example, the trend which has played out in the rest of the world of more passive funds, or less active funds generating excess outperformance. So there are the reason for our passive basket to exist is one, to complement the active basket. Number one. Number two is to give choice to the investor, because investors have their own belief system. Now, one can question that, don't worry about investors' belief system. You stick to your belief system that active can outperform. So my belief system is good fund managers will beat active. Uh, Average fund managers will not beat passive. I mean, good fund managers will beat benchmarks. Average fund management principles will not beat benchmarks. But
Right.
we are still giving choice to investors because we want every investor to be a part of our platform. And we are saying that, if you are a believer of passive, have some money in passive. I personally have around 10 to 12% of my money in our three passive strategies. We have four. I have in three right now. With the view that tomorrow, for some reason, if active doesn't do well, and remember, temporarily active also underperforms. There are phases once in 3 4 years where active cannot beat the benchmark, because our framework ensures that you don't buy everything from the benchmark. So what is my negative list in the benchmark? There are years when that may do very well. Now, as an investor, behaviorally, if I am weakly wired, I may want to then jump out of the active fund because it's not beating the benchmark and run away. So to manage my own behavior, to curb my own behavior, I also have some part in passive, which every day in the night, if I know that, okay, this year passive has done well, I say, okay, I also have 10% in that. So let me not worry. So it's more a behavioral tool to offer that choice. And there are some investors who are very firm believers of the passive trade, where they say that if in US this has happened, in Europe this has happened, there is no reason why in India it will not happen. Now, to me, that is the zone of prediction. Rather than predicting, we are happy to operate with another first principle, which is not get anchored in either or debate, but look at and as an important dimension. There's no harm in having and then let the best design win.
Right. Right. Kalpen, also, it's the AMC space is a fairly crowded space. There are close to 40 plus, and I don't know, it might increase also. So as DSP, where do you think the edge lies? And let's say an investor looks at DSP, what should be the basic thought process that he should have about DSP? What do you stand for?
Okay. See, I think the edge for DSP, which is our history and which is the structure of the company, which is the design of the business model. We are a family owned, professionally led investment firm. Look at the landscape. In the rest of the world, um, the largest mutual funds or the most successful mutual funds are standalone mutual fund entities. They are not entities which have 10 other businesses. Today, our ownership design allows us to build a very decisive, a single monoline investment management business. So we have no hedge. We have no hedge in terms of, if we don't do well here, something else will make up for the overall group profits. We have to ensure that we create great outcomes and results for our investors. So we are completely, aligned with very high skin in the game. Our entire skin is in this game only. Number one. Number two, the beauty of being, family owned, where I don't know if you're aware or your investors would be aware, but the group is 155 years old now. And it was the founding one of the founding members of the Bombay Stock Exchange in the century 1800. So there is a lot of length. Now we all know that compounding is all about length, is all about time, is about longevity. The organizational design is created in such a way that it allows us long-term decision making. We are greedy, but we are long-term greedy. So I would define, our opportunity as being long-term greedy and trying to build a business model for the real long term. In the investment management business, which you mentioned is very crowded, we've been around for 25 years. And in these 25 years, we've seen multiple cycles. So a lot of experience which resides with the platform. A lot of reputation of trust and integrity that the name DSP carries, which allows us to have a very talented pool of professionals across functions, not just investments, but across functions. So my belief is that the investment business is a combination of trust, philosophy, and time horizon. We put all these three together to start with. So that's I believe for me, my edge is in the design to start with. We don't hesitate in giving up short-term opportunities if we believe it's not good for our investors. So to give up the small cap fund when it was 67% of our daily flows and it was 63% of our distribution footprint at that point in time is a easy decision when you are operating in this type of a organization design. The design of the organization makes a lot of difference in strategic decision making. Um, when we went through our own, credit challenges, the decision to say that for one full year we will charge zero management fees on our 5,000 crore, size credit fund was a 1 minute decision because it was designed with a long term orientation that if our investors have gone through this accident and we want to take some part of that pain, it's an easy decision in that construct. So that's one part. The second part of our edge that we are work in progress and we are building on, which I believe will help us in times to come, is in leveraging technology very aggressively on different dimensions of our business. So the way we basically there are three pillars. One is the pillar of raising money, which is how customers and distributors really connect with us. So I think we've created some amazing digital properties for distributors and investors to come and invest on our website and take their investment decisions. And I believe they are reasonably cutting edge, and they will continue to be our primary driving force. The second part is internal automation, and the third part is how do we invest money. Now, how do we invest money is a soul of the business because that will generate the alpha for our investors. And here, the way we are building our edge is a lot of help from automation and technology to convert a lot of data today, which is in excess, through frameworks into decision-making tools. So the entire investment function is building on an internal project on data-driven decision making. So we are leveraging a lot of technology on both sides, raising money and deploying money. And lastly, I believe, and this is work in progress again for us, is the final outcome. I want our edge to be the outcome and the result for the investor. So simplicity of how we communicate with our investors, honesty of how we communicate with our investors, and ensure that their account statement returns are better than the returns they see on our fact sheet. More often, the fact sheet returns are higher, account statement returns are lower. We want to invert that whole game, and we want to leverage a lot of simplicity in communication and honesty in communication, and highlight the frameworks of investing to our investors. That when can you go wrong, when can we go wrong, when can we go right, when is risk more, and when is the risk in our favor, so that we help our investors choose products right. So basically, the business model design, um, leveraging a lot of technology and data to build for the future, because we recognize the trends are changing, and we cannot compete with some of the largest AMCs uh, on areas of their strength, which is large branch networks and large number of physical presence. Today, every mobile is a branch for me. If a customer has a mobile, that's my branch. So how do we do sensible work to be a part of that mobile? And we don't need so many people. End of the day, we have 30,000 distributors who do sales for us. So our whole approach is that we focus a lot more on manufacturing, which is fund management and good product ideation. A lot of focus on marketing communication with simplicity and honesty, and using data and technology. So these are the three pillars on which we are building our foundation for the future. And the fact that we've seen multiple market cycles. There is an impeccable reputation that the name DSP brings to the table, attracts a lot of talent, and attracts a lot of trust. Is a good combination for us to build a very long-term organization.
Kalpen, you were also mentioning on the skin in the game. It
Yes.
also plays an important part. So I also know that a lot of your colleagues and yourself invest a lot of your money in DSP. So what's the broad thought process there?
Yeah. So since we are a full service fund house where we have all styles of equity funds, all styles of debt funds, all styles of global funds, uh, our whole view is that every investment opportunity which is there in the market uh, can be played through any slice of our equity, debt, active or passive products. We have active funds, we have passive funds. So the whole range is available. So the whole hypothesis is that if we are telling the entire world, let's say there are currently 3 crore investors invested in mutual funds and potentially another 20 crores. When we are telling all of them that mutual funds are the best way to invest and we believe that we deserve your money, so last year we made this internal decision that every employee of DSP, we are around 481 people, all of us invest our money only in mutual funds, no stocks, no bonds, unless that asset class is not available to you, then it's a different story. But if that asset class is exercised through any of our products, then we invest our money only in mutual funds, and within that, only in DSP. This is with the larger belief that we have the whole range, which is important for investor to capture the long-term compounding of equity or the short-term safety of debt. We have the entire range. So when we are telling 20 crore potential investors in the country that you should invest with us, there is less reason for us to go and invest elsewhere. And from a fiduciary responsibility point of view, also it makes us more accountable. So if we underperform, we feel the pain. Investors can jump out and go to someone else, but we cannot jump out and go elsewhere. So this is basically a mechanism reflecting confidence in ourselves, confidence in our work. At the same time, acknowledging that when we go wrong, it is our responsibility to fix it fast and ensure that we create value for investors. Because there are
So,
times we will go wrong. Yeah.
right, right. So, last question, Kalpen. Now that you've seen so many cycles and you would have seen different sorts of investment behavior, if you were to sum up, let's say, your three top advice or for any new investor or experienced investor, if you could sum up as if you follow these three things, probably you get 80-90% of your investment life sorted. So, what would that be?
So I think I'm very fortunate to have worked in four investment firms with some of the finest investment leaders and minds in the country, starting from DSP, IDFC, Birla, and Prudential ICICI. That has shaped my investment thinking over time. Um, it's not easy to put all of it together in 3 lines, but I remember I'm deeply influenced by the 7 or 8 words that this fund house called Fundsmith has. I think let me try to remember. It says buy good companies, at good prices, do nothing.
Yeah.
So these are the 7 or 8 words that convey the entire investment ideology. So I would just tweak it by saying buy good asset classes uh, at good prices, and then do nothing. Then don't keep reacting to market noise and your own behavioral stimulus. So what does it say? That invest in good businesses and good companies and good underlying asset classes um, at the right price is very important because naturally we are wired to invest at the wrong price because we like to invest when past returns are very good, and when they are extremely good it means the price is very bad. So I do feel the concept of valuation is very important at an aggregate level, at an asset class level. And then the third thing is that real compounding happens only with time. I'm a chemical engineer, and actually, you don't need to be an engineer to understand the formula of compounding, where uh, between principal, return, and time, principal is multiplied to return. Return is plus sign, but time is with an exponential sign. So the real compounding comes with time. So time is very important. And for R to be reasonably good, it is important that the R does not become too negative, which happens when we invest at wrong time. So when money is invested at very high prices, the first 1 or 2 years give you very sharp cuts in your capital, and then to get back is very difficult. So I have personally witnessed two very sharp bear markets. First one was beginning of the career with the tech fund, burst, where we've seen 85% loss in NAVs. And then the second one was the 2008, 9, 10 phase, which was around 60% drawdown. I hope the third one is, again, half of the last one and
Yeah,
not
hopefully.
as much. But the realization is not losing money, permanently is very important to stay relevant in the game. And I think for a lot of investors who earn money on a monthly basis, they are largely sorted in a way because the flows come every month. You are investing across all valuation cycles. You are not buying only at the peak of valuation. So to most investors who are recipients of monthly salary like all of us, by default the solution. So simply put, I also tell a lot of people that if you just do SIP in an asset allocation fund, uh, you don't need anything else then. It largely takes care of valuation, it takes care of time diversification, it takes care of asset allocation between debt and equity. Then you have to do your gold allocation separately. But these two things, in the most simplistic way, solve for most of the investment barriers that we have otherwise. So that's what my whole summary is. And like I said, I like asset classes which are underperforming. I like investments which are around a framework. I like investment managers which are fundamentally solid and focus on the framework. And then within that, I like more if they are underperforming when you have new money to invest. That's it.
Great. Thank you so much, Kalpen. I mean, personally, it was a super interesting and an informative session personally for me. And I'm sure like all of our investors will have significant takeaways from this interview. Appreciate your time, Kalpen. Thanks.
Thank you so much, Arun, for asking these questions, and always look forward to talk to you. Thank you so
Yeah,
much.
yeah. Thanks. Thanks.